Hi, this is Seema Arora, and this is a podcast on sustainability, climate, business, economy, and tech. In today's podcast, I'm going to focus on the story of, is there an AI bubble? In this talk of overvaluations of companies, let's focus on a story that's really relevant here, and that is why is Google being undervalued by the market? Google just released its Gemini 3 LLM that has outperformed ChatGPT 5 and other competitors on all major benchmarks. This is great news for Google, and the market has caught on to it. Google stock has been rising, but still not as much as it should. And here are some of the reasons why that might be the case. Sundar Pichai also mentioned that there is irrationality in some of the AI stocks. Well, but in the case of Google, definitely it needs to be rationally valued at a higher price. So again, coming back to the Gemini 3 LLM that has outperformed ChatGPT, there are many reasons why that has happened. Of course, it's based on the transformer architecture, which Google architected in the 2017 paper, Attention is All We Need. The foundation of every modern LLM. Google has a structural long-term advantage in this field. Gemini 3 is natively multimodal, which means it processes all the text, images, audio, video within a unified model, as opposed to ChatGPT, which uses add-on tools for things other than text. Gemini has a larger context window, a better reasoning, and can access real-time data from Google search engine, whereas ChatGPT relies on Bing. There is no doubt that Google has 25 years, since the inception of the company, years of proprietary data, and that spans the search index, the knowledge graph, YouTube, maps, and many more data sets that no competitor can match. So that's a huge advantage for Google. As far as if we consider the technical and infrastructural advantages, first of all, Google employs very high caliber PhDs, and by some estimates, it's like 16% of their workforce is a PhD, though that's not for sure. But they do work on Google's ML and chip teams, giving it unmatched and unprecedented research depth for people who are really focusing on these core competencies for Google. Google has designed its own chips. The TPUs, the tensor processing units, are already in their 8th and ninth generation, including Ironwood, and they're already in production. They've been fabricated through partners like TSMC, and their other partners include Broadcom. These have been used to great extent in their data centers as well as in the training of their LLM models. And one very interesting thing which Google has done, and that is really an example of a company that does things better for the environment and for its bottom line. Of course, they're very focused on the bottom line, which means that they've reduced their operating costs of power consumption. The TPUs in many cases are 3 to 80% use less power for equivalent amounts when you compare it to the GPUs. And that means on a lot of metrics, they're using less power and they're emitting less carbon, which means also that their reliance on the grid is not going to be as much as for the other chips. Now let's look at so the idea that Google has what is called vertical stack integration. It has search, it has ads, the cloud, the LLMs, the Android ecosystem. It's a whole fully robust system which is giving revenue at each stage of this stack. They are enterprise ready today, not 10 years from now. Gemini Enterprise is already available for corporate subscription, and as soon as it rolls out, and it's already being deployed at scale potentially across Google's 2 billion plus users. So the users are there, the infrastructure is there, the chips are there, and the chips are really falling in place for Google. There is deep integration. Now they have a new profit engine. So besides the YouTube ads and besides search and ads across those business lines, cloud has emerged as the new profitability engine for Google. And with AI, there will be deep integration across cloud, workspace, YouTube, and Android, immediately creating monetization pathways for Google. Now, let's look at the real important uh, dimension here, and if we look at the capex for Google, while other companies are claiming that they are making 1.4 trillion of investments into capex into AI, the Google, so currently this year, first of all, we should know that its capex has increased significantly since many years now, but since 2019 to 2024. And now this year, it's going to be around $90 billion. But this $90 billion, you cannot compare to other companies that are promising these investments, because these are coming out of its own profits and not from external capital that requires servicing of debt. So Google is using its own profit to these capex investments. Any new cloud capacity also will benefit Google in three ways: A, to run its own LLMs and supporting existing profitable businesses, as well as selling cloud capacity to enterprises. So there is absolutely zero risk of AI overcapacity buildup for Google, unlike its competitors. And that is very clear from its trajectory of growth, from its trajectory of being disciplined and having delivered on many accounts. So let's look at the capex trend. Google's capex has grown from about 10 billion to nearly 60 billion and continues to rise each year. And in this case, if we look at the numbers here, I'm going to focus on two main numbers from the corporate finance. One is the return on capital employed, which is a measure of the profit generated per dollar of capital employed. So it is the bottom line profitability. Google's return on capital employed from 2019 to 2024, has increased, and it's steadily on a rising trend. So from 2019, it was about 17%. 21, 23, it was 21 to 29%. In 2024, it's already 35%. And this trend, and what is the number again? It is the return on capital employed, which is the bottom line profitability term to look at. And that is increasing. It is a clear upward trend, suggesting that Google is becoming more profitable with each dollar of capital being spent on capex. That is very good news. Now, Microsoft has also been performing similarly and well, but here is the catch. Microsoft currently does not have an LLM that is ready. Microsoft is hiring aggressively in this area, and of course, it is investing heavily in data centers. So this is an anticipation of the LLM coming through, and there is no doubt that that's their strategy. But in the case of Google, everything is for real. The discipline, the LLM, the chips, the cloud, everything is already a profitable business line. And so let's look at the other important ratio for this capex, and that is the capital efficiency ratio, which is the top line item. It is the revenue efficiency. It measures revenue generated per dollar of capital invested. In the case of Google, this capital efficiency ratio has increased from about 17% in 2019 to 30% in 2024. This shows that Google is significantly improving in turning capital into revenue and not just profit. So, which means that it will grow, the revenue is growing, and the profitability is growing. So, again, by both measures, the return on capital employed as well as the capital efficiency ratio, both of those are being on an increasing trend. So now you can come back to the other idea that the capital invested, that trend has also grown for Google. And that graph shows that capital expenditure for Google has been growing since about 2015 even. And while it was netting about 30 billion and then 50 and 60, right now that capital expenditure is increasing to about 90 billion. And according to some sort of demand projections, that has to double every 2 years and so on for the AI models to run and for inference and reasoning capabilities and to have low latencies. So this expenditure will increase. But the story again is that Google on top line, which is revenue increase per dollar spent on capital or capex, is increasing. Profitability, that is the bottom line item, is also increasing for Google. And means that as capital expenditure increases, you're going to see much more growth, profitability, and revenue generation. So there is no doubt that right now Google is being undervalued. Let's look at the other advantages again. The data advantage is very critical. No competitor can replicate Google's scale. It has a 25-year search index, a knowledge graph. It has the YouTube uh, content, the Google Maps spatial data, real-time behavioral data from searches, and that feeds into directly into the advertising and the monetization through ads. And lastly, I want to reiterate that because of its focus on increasing its, or rather decreasing its operational costs for the data centers, it has focused on the efficiency of the data centers. Unemployed chips that are using less power, search for whatever metric that you might have, which means that they are getting more for each unit of power, more compute for each unit of power. And this means that compared to other GPUs, they are going to be less reliant on the grid and they're going to create less environmental damage in case of, reliance. They are also moving into, like others, being into nuclear reactors. And one thing is for sure, Google has always been at the forefront and it has signed numerous power purchase agreements since about 2009 or so. So they are very much aware of the demands for power for this massive compute that AI is going to generate or unleash. But Google is very well prepared, and with its really educated workforce, Google is poised to explode. Now, let me, in conclusion, also cite a number that I saw on Yahoo today, and that is telling me that Google is seriously undervalued. If we look at Google's PE is about 31.79. And I'm just comparing to NVIDIA. NVIDIA's PE currently is 43.65. Now, if I look at the earnings per share, and this is trailing 12 months, for Google, it's 10.13. And earnings per share trailing 12 months, NVIDIA is 4.03. So clearly, uh, Google is performing better and it needs to be valued much more by the market. And this is what I would say an irrational undervaluation of Google given its explosion into AI. So with that in mind, that's all I have to say. I would like to place a disclaimer. This video is for educational purposes and I have no positions in the stock. That's it for now. This is Seema Arora signing off and happy Thanksgiving.